Welcome to Bunnex Investment Group. In this video, we are going to break down a very powerful trading strategy that can help you fulfill your trading dreams. So we'll go through everything we need to know pertaining the swing trading style that I usually do. But before we jump into the whole video, make sure to check out our Telegram channel. The link is right in the description box below, and subscribe to this channel so that you won't miss any new content that we upload on this channel. So the trade examples that actually led me to creation of this video are these ones. A lot of people have been asking, how do you actually hold trades over a long period of time? As you can see, this is pound against the dollar, and I have 1-2 trades which I'm still holding even in this particular coming week. This is CAD against CHF. Buys, the first buys were at this point, and this was the daily time frame. This is the H4 time frame, and this is NZD/USD on the daily time frame, right? So I'm going to break down how exactly you need to actually do in order for you to hold trades for quite a long period of time, right? So this video is going to explain this strategy, but we are going to do so in 4 parts. We need to first define the higher time frame market influence, and then talk about the market impulsive moves, which are basically called levels, then strategy definition, and the last but not least, which is the most important one, is when we are going to move over to the charts, so that I'll illustrate how you actually get these points and why the reasons behind holding trades for quite a long period of time. So let's jump right into the higher time frame market influence. So to trade consistently with higher accuracy, we need to know the higher time frames, because these are the time frames where all the money is. Top hedge fund managers use all the available time frames as the daily to the monthly time frame. They are used as economical market bias. So if ever, let's take for instance, if ever Britain is actually on a bullish side in terms of economical improvements, it means the daily or the monthly time frame is actually going to take long in one particular direction, right? So us as retail traders, we usually tend to focus on smaller time frames, right, which are the M5 to the H4 time frame, and these ones are what we call liquidity pumps, right? These are there to provide liquidity in the market. They are used to hit stops, hunt stops, so that over the long higher time frames, the market will actually have a long period to play. So as I have said, top hedge fund managers actually use the higher time frames for market bias. This actually result after the smaller time frames hit stops and so forth, so that we fund the market and attain liquidity. Therefore, to make large sums of money without over trading, which is actually one of the diseases responsible for your losses, you simply check the higher time frame bias and then find a good entry point on the smaller time frame and hold. So this is the summary of the whole video: finding the higher time frame bias, finding a good point of entry, and then hold, just like that. That is what you need to do, right? Why do we say so? On the higher time frame, if we look at probably an impulsive move that has been issued on the higher time frame, it will look like just one move like this. So this is a higher time frame presentation. But switching this down to the smaller time frames, you'd see that this impulsive move was actually achieved by these ripples. So these ripples, as you can see, they had liquidity grabs, stop hands, and so forth, so as to actually facilitate the liquidity required to move with such magnitude on the higher time frame. So on the smaller time frame, as I've said, they are called liquidity pumps. They are actually there to induce traders hit their stops and attain liquidity to move in the right direction that we want to achieve, which is in confluence with the fundamentals of a particular economy. So after that, as I've said, this is an advanced strategy. An advanced strategy needs several parts or pieces to actually complete the puzzle. We've talked that on the higher time frame, that is where we actually get the bias, and then on the smaller time frames, that is where we get an entry point that supports what we have seen on the higher time frame, right? So from there, we are now on the market impulsive moves, right? So in this strategy, your first job is to identify higher time frame market zones, right? Particularly the current place in the cycle, right? What we call a cycle is basically a market maker cycle. And I'm not going to talk much about that in this video. You need actually to refer to our advanced course. So these zones, right, includes what we call the peak formation, right? It might be a peak formation high or a peak formation low. This is a higher time frame, highest point available on your charts, right? That's your first job of considering or identifying that zone. Then from that peak formation high or peak formation low, we usually have what we call a level 1 movement, right? A level 1, it's basically an impulsive drop or rise and its consolidations. Usually after an impulsive drop, we need more liquidity, therefore the market will usually consolidate. Then level 2 and its consolidation, and level 3 and its consolidation, right? So in doing these things, we now need to use our logic, right? Logic will actually need you to ask yourself these questions, right? So we are saying after identifying these, the next step is to ask yourself these questions. What is the market bias, right, on that higher time frame market, higher time frame that you are looking at? What is the market bias? Is it up or is it down? Where am I in the higher time frame cycle, right? Level 1, level 2, or you are still at the peak, right? If you are in level 1, we know that we are actually going to expect level 2. If we are in level 2, we expect that we are going to have level 3. And if we are in level 3, are we going to get a reversal and a reset point, right? So how many levels needs to be issued to complete the cycle? So these are the questions, right, that you should be jotting down in your diary and actually answering yourself, right? That's now application of logic, right? So this is what we'll be looking at. In this case, we are seeing that there are 1, 2, 3. So this is a lower time frame presentation, and this is a higher time frame presentation. So we say for every preceding time frame, we expect it to have 3 levels of its lower time frame. What I mean is, if we look at the monthly, we expect to see the weekly having 3 levels in one monthly level. If we look at the daily, we expect to see 3 H4 levels in one daily level. If we look at the H4, we need to see 3 H1 levels in one H4 level, and down to the M15 time frame. If it's one M15 time frame level, we expect to see 3 M5 levels, like that, right? So basically, this is an illustration of how the impulsive rises and drops actually interlink with each other. It's basically a time frame relationship. So here's the strategy definition. I've actually laid down the foundation that is required for you to understand what I mean, right? So all the above information was given to you to actually provide you the right background to understand what we are going to do on the charts. So steps for this strategy, right? Not where we will always anticipate completion of cycles, right? By that we are saying 3 levels of rise gives us a completed cycle, and after 3 levels of rise we anticipate to see a reset point if ever the higher time frame is not yet complete, right? So the first step is to go on the monthly time frame. This is basically a summary of how we are going to apply this strategy. Go on the monthly time frame and identify levels. Scale down to the lower time frames, that is the daily, the H4, down to actually the H1. I understand that this was not enough for you to apply this strategy, so let's go over the charts for clearer explanation. Right, so this is a pound against dollar, and these are the EMAs that I use if you want to know more about these EMAs, you can refer to our previous video where we actually talked about these exponential moving averages. So the first thing that I've said is actually to start on the economical market bias time frames, which are the monthly time frame. On pound against dollar, where are we going? We can only see that on the higher time frame. So I'm now going to switch to the monthly time frame, right? So on the monthly time frame, we've said your first job is to identify the zones, right? The zones of the market. So in this case, we are going to say, right, we had this highest point, right? The market went down and we created this new point. So this is going to be my first reference point, or the peak formation high that I'm going to use, right? In counting of levels, we use rectangles. If you have been following this channel, we would love to use different colored rectangles. So in this case, this is a white rectangle that I'm going to use to mark the levels of the monthly time frame so that I can see where we are in the cycle. So we had level 1, right? After that level, we had level 2 here. Then after that level 2, we had level 3, right? So having 3 levels means that our cycle has completed, right? After cycle completion, what do we expect? The next thing that we expect is actually a reset point, right? In this case, we can see the market actually gave us a reset. If we are going to apply the smart money concept, we can say it gave us a reset on this particular order block, right? So making that visible, we can say we resetted at this point, right? So after a reset, we are now interested in seeing what has been happening on the lower time frame, because this is the point that we are interested in, and this is the point where I entered my sales that I showed you earlier before, right? So going down on the weekly time frame, from the reset point, we can see the first level. We had the first level that went from this point to there, right? And now we are in this particular second level of the weekly time frame. Mind you, in one monthly level, we expect to see 3 weekly levels. So I'm going to mark them as well, right? I'm going to mark them, the weekly levels. Now I'm now changing the color to black on this weekly time frame so that it will be clear. So this was the first level. We had the first level, right? The second level. So on the weekly time frame, we can see that we now have 2 levels that have been issued, like that. We have 1, we have 2. So by the logic that we were discussing in the slides, we now know that we are going to expect the third level like that. So we need to see another drop. That is if we have completed this particular weekly level. So to see or to check if we have completed that level, we may need to check using the smaller time frames what is actually taking place in these 2 levels. So we are now going to the daily time frame, right? On the daily time frame, we are now inside those weekly levels that I've shown you earlier. So the first daily level, right? Pull back, the second daily level, and the third daily level. Let me now use a different color. In this case, I'm now going to use let me use yellow. So we had the first daily level, right? After that daily level, we had the second daily level like that, and then we had the last level like that. Therefore, this cycle was complete, and we had a reset point at this point. So right now we can safely say we had this level, right? After that level, we had another daily level, and with that in mind, what can we say? We can say that we still haven't completed that that second weekly level, which is this one, because we have seen we have 3 daily levels. We have 3 daily levels in that one. So going on the smaller time frame, we are now on the H4 time frame, right? On the H4 time frame, this is what we see. What can we say? We can now go back to correct what everything that we have drawn. Let me now use a red color. So we had the first H4. We have the first H4 level here. This is the first H4 level, right? I'm going to mark with its consolidation like that. Then we had the second H4. Then we had the third H4 like that. Therefore, this daily level was complete. So where can we say we had a reset? A reset actually occurred at this point. Therefore, we need to actually revise this and put it back there, so that this will actually start from that point, right? So from this H4 time frame, we can now see that from that reset, we had this H4 first level that actually went with its consolidation to that point, right? Then we had the second H4 level that actually started from this point to there, and then the last H4 level like this. So what can we say? We can say that we are now starting a new cycle of the H4 time frame. Therefore, this is a reset point, right? So an H4 cycle will need to actually start at this point. If we go back to the higher time frame, which is the weekly time frame, this is what we can see. We need one more H4 cycle to complete going down for this weekly time frame level to be completed. We've said in one daily level we need 3 H4 levels. So in this case, we still need 3 H4 levels going down before a pullback of this manner comes. So that is how I'm actually still holding those trades on pound USD. It's because I still know that we still anticipate to see 3 more H4 levels like that. So if we are going back to the fundamentals, you can see that recent NFP news was in favor of the US dollar, and that can also push the market downwards in favor of the US dollar. So basically, that is how you apply this strategy. And if you can do it correctly and in the rightful way, I actually tell you that you'll be very, very successful. You won't need a lot of trades, but maybe 2 per month. That will give you hundreds and hundreds of pips will be okay. And if you can't find entry points within these cycles, you may as well use our indicator, the Portal FX indicator. It can tell you when to buy and when to sell along these cycles. On that note, we come to the end of this video. Thank you for watching. Like and subscribe.